Our first speaker today, we've got Jonathan Prince from Allica Bank, a bank that we've not heard of probably 14 months ago, I'll be quite honest. And then one of my staff said they'd spoken to somebody they knew within the business who worked for another broker, and they were doing quite a bit of business with Allica. We brought them on board. They've been an absolute godsend. They really have. Great. It's great to have them on board. We've now got a fair pipeline with them, and they're doing stuff that others won't. So, okay, so you should have received this morning from us. This is the commercial mortgage product guide. That's been sent to you by email this morning. If you haven't received it, then let me know within the chat, and I can arrange for something to come to you. Check your spam folder first, though, because there were 6 attachments. So there's a good chance if you haven't got it, it's end up in your spam folder. But nothing has bounced, so that should be with you by now. Okay, a little bit on Jonathan. First of all, he's been working in commercial finance for the last 9 years, all of which has been spent with small challenger banks. He has largely worked in credit functions, giving him a strong understanding of business risk, and moved into relationship management at the start of 2020. His interesting fact, Jonathan has moved house 26 times in 31 years. That's not because he's a member of the, what's it called, the OCG, nor is it, what was the reason behind that, Jonathan? I can't remember. What was it?
Just a very hectic upbringing and parents that were property developers when I was younger. So it was move in, do it up, move out. And I've actually moved once more since I last spoke to you as well. So
right, okay. So you haven't got to think about paying stamp duty or something like that. Okay, so
that was the reason for the last move, to avoid that one actually.
Right, 26 times in 30. I've moved 5 times in my life, and that's 5 too many as far as I'm concerned. Or actually 4 too many. So as far as I'm concerned, don't want to move again. Anyway, Jonathan, it's over to you. It's all yours. I'll be back. I'll see you in about 20 minutes.
Perfect. I'd just like to obviously start by thanking Tony and hoping that some of the messages about lenders in the market at the moment don't apply to us. I'm pleased to say that we do still have 100% approval rate with specialist cases, and long may that continue. So yeah, the purpose of today is really just to talk a little bit about us for those of you that don't know the name, conscious we're a very new name in the market still. Give you an overview of our 2 commercial mortgage products, and then I thought I'd spend the meat of today's presentation on some case studies. So we're going to be going over 7 cases that are all drawn deals, so deals that we have completed rather than just sort of issued terms on, and we'll save any questions for the end of the presentation. So starting off with who Allica are, we are one of the newest commercial lenders in the market. And the purpose of the business was built around being a true alternative for SMEs. So as we stand today, we offer commercial mortgage and asset finance products, as well as some deposit products, but we're looking to build that out to be a full service offering. So we've got several teams working away in the background at the moment on our current account and payments account propositions. And then once we've got those in place, the world's our oyster really in terms of adding products onto that to support all the multitude of SMEs out there. The bank was built on 2 key premises really. One was local relationship management. So we have a business development team, of which I'm part, which work with our broker partners. And we also have a relationship management team who are very much in their infancy at the moment, but are building out to be, over the next couple of years, really a national coverage team. And they will be a local relationship manager for SMEs of all sizes. You know, we haven't got this cap around you have to be turning over X million a year to get yourself a relationship manager. It's really about trying to bring back that relationship banking from many years ago. But combining that with the best in modern technology. So as hopefully Tony's team can attest, the way that we operate in terms of getting applications over to us is all very digital, but that digital process is there very much as a tool to get things in rather than a barrier. And some of the technology that we're using is class leading. So the bank is owned in the main by Warwick Capital Partners, who are a private equity fund, and we also have some investment from BAE Systems Pension Fund. The beauty of our shareholding is that it's not private individuals and it's not councils or anything like that that perhaps have a obligation to hit certain quotas in certain sectors or in their own community, we are very much left to run the bank on a full commercial basis. So yeah, that's Allica. And as I was talking about earlier, our roadmap for an SME-centric bank is on the screen at the moment. So, as I say, the top product, the deposits and the asset finance are already in the market. And then the goal is to be, not perhaps a high street challenger, but at least offer a similar product offering, so we can really compete and offer our customers an alternative to the standard high street offerings. So our proposition to the introducer market is built around 3 core values. The first is far and away the most important, and that is being straightforward, being honest with people on what we can do, what we can't do, not putting unnecessary red tape and barriers in the way of getting a loan from us, and trying to make the process as simple as possible. Integrity for us is all about following through on those promises that we make. So, if we say we're going to do a deal on me talking to a broker, I'm talking from a very much joined up view from our underwriters, from our credit team, from our back office team, and we really do follow through on the promises we make up front. And collaboration, we try to work with our brokers rather than against them, and very much try and work with them on how to structure a deal and how to get to an approval, rather than going for perhaps the quick no or the easy no, or as Tony alluded to earlier, I think there is sometimes a tendency for lenders to ask questions in such a way that is in essence a constructive decline, because there's never going to be a suitable answer to that question. So for us, it's all about that partnership in working together to get an approval for that customer. So on to the first of our products. Our commercial owner-occupier offering is our mainstay product, and this is for businesses either looking to refinance or purchase their current trading premises, perhaps to expand into a larger premises. We see a lot of people that have perhaps been renting for a number of years and have been offered the opportunity, particularly over the last year, to buy the freehold to get a little bit of extra cash in the landlord's back pockets. The product's open to all of your standard borrower types, so limited companies, LLPs, partnerships and sole traders. And we can also handle where a borrower is intending to set up a new company to own the property, but hasn't perhaps done that yet, all through our portal. Loan sizes are between 150,000 and 3 million, although we do have a 2 million single asset cap for investment deals. Loan to values I'll come on to a little bit later, but typically up to 70% of vacant possession value. Terms are between 5 and 25 years, and they are full committed terms. So it's not a 5-year commitment with a 25-year repayment profile. It is a full 25-year committed loan. For our owner occupiers, we offer the first 2 years on an interest-only basis, followed by standard amortization. We found that's been particularly useful for a lot of businesses that have been perhaps adversely impacted by the events of the last year, where they can take a little bit of a breathing space in their repayments for the first 12, 18 months. And then go back onto the normal profile. Margin ranges are between 4.5% and 5.85% plus base rate. They are based in essence on 2 key factors. One is the loan to value, so the lower the LTV, the lower the interest rate, and the other is the risk profile of the customer. So what that means is the stronger clients, those that represent a better risk, will benefit from our lower pricing available. Debt service cover, we use our own version of adjusted EBITDA, which is in essence just making some sensible add backs around dividends, rent, those sorts of things. And we do a very straightforward 130%. And in terms of our security, the only thing we take as standard on every deal is a first legal charge on the property. Debentures, personal guarantees, additional security is very much case by case. We only take it if we really feel we need it. And we also articulate why we're taking it. So, for example, we might want a personal guarantee to cover a 5% exception on loan to value, or if debt service cover is a little tighter than we'd normally like it, we might perhaps take a guarantee for 2 years repayments or something like that. But it is by no means a one-size-fits-all approach to additional security. Onto the commercial investment product. This is very similar, so I'm just going to talk around the key differences here. Same borrower types, same loan sizes and LTVs. On the repayments, we offer a full interest-only option. So that is a 5 to 10 year interest-only loan. And that is on the same terms as our capital and interest product. So there's no higher interest rates, there's no reductions in loan to values. It's a straightforward case of, if we would do that deal over 25 years, you can have that case on a 10-year interest only. Our typical margin range on the investment is slightly higher, so it's between 5% and 6.3%, and that's just to reflect our commitment to those trading SMEs, and it's calculated on exactly the same basis, so that mix of credit score and loan to value. And our debt service cover, again, we keep really simple. It's 135% of the repayments using a gross rental income. There's no deductions from gross rent to a net rent. There's no stress testing or anything like that. The only thing that we do ask is that interest-only loans would service on a full capital repayment profile. And that's just to make sure that those loans can be refinanced at the end of that term. Exactly the same approach to security, so personal guarantees, debentures, corporate guarantees, very much case by case. The only thing we're taking as standard is that first legal charge over the property. So in terms of the property types, the screen here shows what we're lending on, and in essence, this hasn't changed. So this list has exactly the same property types in that it did in February last year before the pandemic. We've made a couple of sensible adjustments to loan to values on offices and retail premises. The reason being that obviously they have been the worst affected over the last 12 months. And there's been some concern about stability of values in those two sectors. But we are very much still open for business for them. And for the best propositions, they are still able to get our 70%, our highest interest rate. So going down the list here, professional practices we class as doctors, dentists, accountants, solicitors, anything like that is 70%. Holiday lets, and this is commercial holiday lets rather than second homes or anything like that, 70%, and warehouses and industrial units, again, 70%. Offices and retail, like I say, our usual appetite here sits somewhere between 60 and 70%, depending on the proposition. So if you've got a really nicely located office let to a very strong covenant on a decent lease, that's going to be at 70%. If it's perhaps a more secondary location and you've got some shorter term leases in there or some local tenants, you're going to be between 60 and 65. And that's the same logic on retail. 70% is anything of the sort of convenience store off license nature would be at the 70% mark. Perhaps high street retail might be closer to 60 or 65. Garages and vehicle showrooms and cafes, restaurants are 65%, and purpose-built student accommodation is 60%. The property types at the bottom are those which include inherent goodwill in their value. So pubs, hotels, convenience stores, nurseries. For those properties on an owner-occupied basis, we do lend against that goodwill value. So if you've got, an additional 120,000 over and above the property value in goodwill, we will go up to 65% of that value, just with a check back to vacant possession to make sure we're not going too high against the bricks and mortar. So as important as it is to cover what we do, it's worth going over the sectors that we don't do as well. So we don't have any appetite to lend to the usual categories of arms and weapons manufacture, adult entertainment, gambling, animal testing, anything that could present a reputational risk. We're also not in the residential market at all, so we don't lend on buy-to-lets or HMOs or anything like that. And we don't currently have any appetite for nursing homes or anything in the care sector, and anything of the sort of park home, caravan park type nature. So that covers the products. The next thing I'm going to go through is just a series of case studies to give you an idea of the products are all well and good, but what does that actually look like in a real life scenario? So you're going to have to forgive me here. I'm going to be tabbing between two different pages. So yeah, technology is not necessarily my forte. But this first one was the purchase of a trading pub in Devon. The two applicants had managed and run pubs for a number of years on behalf of other owners, but that was going back around 10 years. Since then, they'd moved into different careers, but they were looking to relocate to Devon and purchase their own sort of live-work business. And given the extensive experience they had in the pub trade, it was the logical one for them to go for. The business that they were buying was very profitable pre-COVID. It was making around 50,000 a year adjusted profit, and it was a very well-rated and reviewed pub in the local area. The lack of direct experience and recent experience for us was very much mitigated by the fact that we were at 35% LTV. And the performance of the business pre-COVID was a really strong indicator for us that it was going to be successful once all the lockdowns lifted. So that was a deal that we managed to get approved. So on to the second. This one was the purchase of a freehold which the applicant's business already traded from. So they'd been the tenant there for a number of years, and the landlord offered them the opportunity to buy the property. The business was owned 50-50 by our borrower and an unrelated individual. So the usual security that we'd normally take on an OpCo-PropCo transaction wasn't available, i.e. we couldn't get resource to that trading business because it was part owned by somebody that wasn't our borrower. So we were able to consider this one on an investment basis, which allowed us to still proceed. And again, although it was a restaurant and it had been closed for a number of months when we drew down, they'd operated a very successful takeaway and meal packs delivery service, which was keeping them floating throughout the lockdown. On to the third one. This was a very straightforward investment case. It was a very experienced commercial landlord, quite simply looking to add another property to his portfolio. We managed to get a 70% loan to value on this, and given it was so straightforward, there was no additional security. It was just a very straightforward, clean offer, and we managed to get this one completed in just over 2 months as well, which was a nice result for the borrower. The fourth one is a case where the applicants ran a very, very successful trading business in the medical supplies industry, which they were actually looking to sell based on the success of, they were one of the success stories of COVID, and profits and turnover had gone through the roof. So they made the decision to sell the business, but they wanted to retain the property, both from a sort of capital growth perspective and for some additional income. So they agreed to sell the business with a lease in place on the trading premises. And despite the fact that they didn't have any investment experience, we still managed to get a loan out to them based on their knowledge of that property, the strength of the accounts, which obviously we had access to. And this was a case where we took a personal guarantee just to mitigate some of the concerns we had around experience. The next one is one of the sort of ones I'm proudest of, really. This was a really unique case where our borrower wasn't in the hospitality business at all. He ran a private security business which was extremely successful, and wanted to buy a hotel and bar close by, partly to diversify his investments into something else. But partly he ran residential training courses in his security business, and was paying other hotels to house his students. and decided, why not put that money in my own back pocket and buy a hotel. So we did ask that he brought in somebody with a successful leisure background on the shareholding and directorship of the business. And we took a corporate guarantee from his security business, which was trading very well. And despite the complete lack of experience, we managed to draw down on a deal in a tough sector with a few mitigating security around it. The sixth one, again, nice straightforward case. It was a purchase of a hotel and bar on the lakes by a highly experienced pub and hotel professional who had a very large portfolio on both an investment and owner-occupied basis in the leisure industry. The intention was to fully refurbish the property to provide a B&B and hotel, and they were going to run the bar themselves on an owner-occupied basis, but have somebody else run the hotel side of it under an operating agreement. And despite the fact that there was no income being generated on day one, we managed to get to an approval here just based on the strength of the applicants and their knowledge and skills in that industry. And on to the last one. This is a very recent one, only completed a couple of weeks ago. This was a loan it was a purchase of a small industrial estate that our borrower was looking to expand their business into part of. So it was half investment and half owner occupied. This one was quite interesting because the profit of the business didn't service the loan in its entirety, and neither did the rent. But when we combined the two, we got to a position that would give us the satisfactory debt service cover that we needed. And again, we were able to work with our underwriters and the broker on this case to take a slightly more flexible view on the repayment and get to an approval, looking at both of those income streams together. So that is it from the inquiry perspective. Any initial inquiries, I've put the details of Tony's team on here. Fire anything over to them. They will pick up the phone to me, send me an email, and we're more than happy to look at any inquiries that you might have. But otherwise, welcome any questions.
Jonathan, it's all quiet on the Western Front as far as questions are concerned from the delegates, but here's the 3 questions that you set yourself and submitted over. So I'm going to test you on these. This first question, are you an online only bank?
We're not, no. So as I mentioned at the start of the presentation, we have 2 main distribution channels. One is a network of business development managers. So there's 9 of us now that work across the country with local brokerages and intermediaries. And we also have a team of 5 direct relationship managers that's going to be looking to expand significantly over the next couple of years.
Okay, next question. I always have trouble saying this. How do you treat OpCo-PropCo scenarios?
Yeah, so this is one place where I think we really sort of stand ourselves apart. A lot of lenders will either look at them on a pure investment basis, so they'll just look at the rental income, or they try and tie absolutely everything from every company in together. So the way we do this is we take a look through to the trading business and we will underwrite entirely on the strength of the business that's occupying the property. And we disregard any lease that they might put in place. Now, clearly we do need a lease to be in for legal security reasons, but we assess them like we would any other owner-occupied case.
Okay, final question is, what changes or enhancements are we looking at making to the products over the coming months?
Yes, we've got quite a few quite exciting changes coming up, actually. So the first is we're in the very short future looking at increasing our maximum up to 5 million. And we're also looking at moving into the care and specialist sector. So we're currently recruiting 2 specialist relationship managers with good knowledge of the care sector. And that is something that we are very much considering moving into. We've also got some other things on our horizon, such as starting to lend in Scotland. And currently we're England and Wales only. And looking at other borrower types, so pension funds, trust structures, and those sorts of things. But one thing I will say is, since we launched, we've not stood still on the product development. Every 2 months there is something, whether it's a small change or a big change or a new area that we're lending in. We're always constantly looking to adapt and evolve the products to be fit for the market that's out there.
Okay, the care home side especially, I mean, that is a real problem at the moment, because there's so few that will look at anything within the care home sector, and those that are in it, service is appalling, is probably not too far off the truth. It really is quite difficult out there. So Dilip has asked a question, business as a going concern, do you need 2 valuations for property and business? Do you use the likes of Pinders?
Absolutely, yeah. So we get a combined report. So Pinders, Christie's, Taylor's, somebody like that, and they will comment on both the value of the property and the goodwill of the business in one.
Excellent. Okay, thanks for the question, by the way. That's a good question. I don't think no one else is typing, so we haven't got any more questions. Jonathan, you're 4 minutes ahead, so we gained 4 minutes, which is always great. So. Okay, no, nothing else coming up. Thank you very much indeed. Great presentation as always. Seriously, everyone who's watching today, this is a great lender for us to have on board. And I know that they are running a limited panel. If you've got anything that comes in on the commercial side of things, please pick up the phone, because they do have some great products, and there's stuff they're doing that really no one else is touching at the moment. And where other lenders are very, very slow to react to the changes in the market, they really are on the ball. So I can't wait for their care home product. We've got about 3 cases at the moment we're trying to place with the 2 lenders we've currently got, and it's a nightmare. So yeah, as soon as possible on that one, please. Jonathan, thank you very much. We'll move on to our next presentation.
Thanks for having me.
Thank you. Okay, so our next speaker is, let me just pick up my clicker, is Josh Knight, who's just appeared, which is great. Josh, can you see us? Everything?
I can hear you. I can see you. Can you hear and see me? Good.
Josh is a big supporter of our web shows. He has, well, right from when we started the actual web shows, when we started last July, he was one of the first to come on board. Immediately saw the benefits, because we had one broker that, after watching Josh's presentation, gave us 2 cases, both which paid out, and then the introducer, I think it was in the region of about 26 grand, which he was quite pleased about. He was that pleased, he's now given us more cases, and we're having one of the ones that Josh has been liaising with my staff on is one of his, and I think that one's he's going to be looking at probably another 20 grand in income, and he's literally done to give us a name and telephone number. So he's quite a happy man, as you can imagine. So I'll just a little bit about Josh first of all, but you should have received Octane's buy-to-let product guide via email this morning. That's not Josh in the photograph, I'll just add, although he does have other things we should come on to a moment, but on the sporting side of things. But yeah, that's with you this morning. Okay, a little bit on Josh first of all. Josh joined Octane February 2018 from Mariana Capital, where he was head of sales. He's got 10 years experience in managing intermediate relationships across private equity and property finance, and during his time at GMAC, RFC, Octopus Investments, Mariana Capital, and now Octane, he has a real passion for property finance, having been exposed to startup, packager, and lending businesses from a young age. He enjoys the challenges of the specialist property finance market presents and likes to work on difficult scenarios. Need to put my teeth in today. Interesting fact, in May 2020, great achievement this. I mean, I'll always bang on about this, but this really was. Josh completed 5 marathons in 7 days, and that's not the old name for Snickers, by the way. That was actual 26-mile marathon in 7 days, and raised 4.5 grand for NHS charities together to support NHS workers and volunteers on the front line of the coronavirus pandemic. I always say give a virtual round of applause for Josh. Sometimes we get little claps, but that was absolutely fantastic. I couldn't even walk a marathon, to be honest with you, Josh. I really couldn't. So my knees would never hold out. But brilliant achievement. So Josh, that's your introduction over. Now on to yourself. I'll see you in about 20 minutes.
Good stuff. Thanks very much, Tony. Hello, everyone. Thank you for the opportunity to talk to you all today. Like Tony said, we really enjoy these events and we get a lot from them. Lots of businesses come off the back of them, so they're proving very lucrative for us. Anyone that doesn't know anything about Octane, let me give you a very brief introduction to us as a business. So we are a specialist, unregulated property lender. We are just over 4 years old. We launched in early 2017. The guys that launched Octane are the original founding management team who founded Dragonfly Property Finance, which is now known as Octopus Property. So they're an experienced management team. They started, scaled and sold successful lending businesses in the past. Here at Octane, since launch in the last 4 years, we've lent close to £1 billion ourselves. We employ 30 members of staff from our London offices, and we won a few awards along the way. I think one of the reasons that we've been able to scale very quickly is that we are well funded. Octane are a joint venture with our funding line. Pamplona Capital Management are our funding line. They're a hedge fund with 18 billion under management, and they are a majority equity partner in the business. So the funding arrangement is no more complicated than that. We're going to talk today about buy-to-let, although we do offer a few different business lines, which we'll come on to in just a second. And Octane's buy-to-let product, for me, has two main appeals to the intermediary market. The first is that we don't stress test. And I promise you, you will get bored of hearing me say that phrase across the course of this presentation, but it is our unique selling point, if you like. The way that our interest rates work is that we only need 100% rental cover at our pay rates. And the product of that is very simple. It means that we can often lend more than other buy-to-let lenders who have a more stringent ICR requirement. The second point is that we're not a bank, we're not a mainstream lender, and we don't have the same rigid credit policy as most buy-to-let lenders have. And that means that we can help with complex buy-to-let scenarios, difficult borrowers, unusual property types, lots of examples to come. But if you can imagine all of the no's that you've had in the past from other buy-to-let lenders, think of those cases as we go through this presentation, because I can say with confidence that many of them will have had a home with us. As Tony mentioned, hopefully you'll have our product guide that's been sent through to you that's got heaps of detail in it. And I won't go through everything in lots and lots of detail because it will bore the life out of you. But let me give you the headlines. We lend in mainland England only. Our minimum loan is £150,000. We lend on residential and semi-commercial property. More examples of that in just a second. The way that our rates work is that our starting rate is 4.99% per year. We defer 1% per year of the interest rate, and that gives you a pay rate of 3.99%, and your monthly payment is based on that 3.99% rate. The missing 1% is just added to the loan. We offer a 5-year term, interest only, and we never charge early repayment charges in the final 2 years. So you can exit without penalty after year 3. Now, why do we defer a portion of the interest rate? And it's for this reason here that's in bold. And it's because we don't stress test. We only need 100% rental cover at the pay rate. So in this case, it's 100% of 3.99%. And the difference that can have in loan to value is enormous in some cases. It can be upwards of 10 or 15%. So for borrowers with a limited deposit or low yielding property, it can be really useful. We have 5 different products, and the rates go up as the case complexity increases. Now, like I said, I'm not going to go through all of this in lots of detail, but I'll give you just a few ideas to pull out of this slide. For the purpose of the presentation, ignore wave 4 and 5. The vast majority of cases will have a home somewhere within waves 1, 2, or 3. So for all intensive purposes, they're the 3 products to focus on. Now, the only difference here is that there is a 0.5 increase in the rate. And the idea is that as a case's complexity increases, you move up that rate scale. So for example, a foreign national will have a higher rate than a UK national. A large HMO will have a higher rate than a small HMO, and so on. Everything you need to know is in the product guide, but it just gives you an idea of how the rates work. 1% a year is always deferred, so your pay rate is always 1% lower, and there's always only 100% rental cover needed at the pay rate. You'll see here across a 5-year interest-only fixed term, the ERCs go from 4, 3, 2% in years 1, 2, and 3, and then fall away completely in years 4 and 5. Right, this is the most important slide of the presentation, and these are the cases that I would like you to think of Octane for. And as soon as you come across one of them, give Tony or one of his team a call. On the left, you've got borrower type, and on the right, you've got property scenario. And this should give you an idea of just how broad our appetite is. So let's start with borrower. Octane will lend to foreign nationals and expats, regardless of where they live, regardless of where they're from, and regardless of whether they have any UK property experience. So one of our biggest business areas are foreign nationals buying their first investment property in the UK. We also lend to first-time buyers, first-time landlords, people with adverse credit, people with low income, or even people with no income at all, and also offshore companies and trusts. There are more borrower types, but they're just the main ones to pull out. On the right, you've got property scenario. We lend on semi-commercial properties. We also lend on residential above commercial, so flats above any kind of commercial premises. Food outlets, gambling shops are all fine. We lend on HMOs of up to 24 rooms. We lend on multi-unit freehold blocks of up to 30 units. We also lend on holiday lets and student lets, ex-council properties, and properties with planning irregularities, and short leases. And I could go on and on and on, but that just gives you a flavour of the types of cases we can help with. I'll give you a few examples of a few deals that we have completed recently. And this is a good example because this case came from a presentation that I did on one of these web shows, and it came through to Tony and his team and was packaged up and sent over to us, and we managed to get the deal done. So this was an interesting case. We would deem this case as quite vanilla. It was vanilla in that the borrower, very good borrower, UK resident, clean credit, lots of buy-to-let experience, good level of wealth. And the property was also quite straightforward. It was a first floor flat in a block of flats in London. Now, the quirk of the deal was that the freeholder of the block had sold the airspace to a developer who was building 2 additional floors on the property. Now, whilst that didn't directly affect our property, the result of the ongoing work was that our borrower offered his tenant a reduced level of rent. So on a £2 million property, the rent was just over £57,500. So it's a very low yield. Now, our borrower needed to refinance the existing debt on the property and needed 65% loan to value to be able to achieve that. So we lent on our wave 1, which is our cheapest rate, 4.99%, with 1% deferred, giving a pay rate of 3.99%. And again, you'll get bored of hearing me say it, we do not stress test. We only need 100% rental cover at 3.99%. And that meant that we could lend at 65% loan to value, clear the current charge with no problem, 5-year term, and remember, no ERCs in the final 2 years. So this table you'll see down here on the right, I think really clearly highlights the impact that stress testing can have on low yielding properties. Here we haven't mentioned who the lender are, but this is a real life offering. This lender can lend at 4.25%, but needs 140% rental cover for a higher rate taxpayer. And that meant that they could lend, in this case, at 48% loan to value, which is clearly no good for a borrower that needs 65% loan to value, to refinance the existing charge. If you compare that to our setup, 3.99%, no stress testing, our maximum loan to value based on the rental was 72%. Now, we didn't need to lend at 72%, but the point is that we're not restricted by an ICR requirement like most, or if not all, of the buy-to-let market. We won't always be the cheapest, but there is a home for this type of deal, and especially on low-yielding property like this. So the introducer listened to the presentation, called Tony. We placed the deal. He drew down within a few weeks, and pretty chunky commission payment on this one. This is a slightly different example. We're moving slightly up the risk curve, if you like, just to give you an idea of the types of borrower that we lend to. So here we've got a new build flat in Battersea being purchased for £710,640. Rental income of 25,500, quite a low yield as you'd expect on a new build flat. Our borrower was looking to purchase the property, and she was a Chinese national living in China, but she did own one other UK property. Just to be clear though, had she not owned any UK assets whatsoever, we would have still been able to lend. In fact, 80+% of the foreign national buy-to-let business that we do is for first-time buyers that don't have any credit footprint in the UK whatsoever. But luckily, this borrower did have one other property, which always helps. So in this case, you'll notice that we've nudged up the rate curve to reflect the fact that the borrower is not a UK national, so the complexity of the case increases. And again, if you look at your product guide, you'll be able to see exactly what the criteria for each wave, as we call them, is. The setup is the same as the last though, just 0.5% higher the rate, 5.49%, 1% deferred, giving a pay rate of 4.49%. Again, no stress testing, 100% rental cover at the pay rate. We lent in this case at 65% loan to value on a 5-year term with no ERCs in the final 2 years. And when I completed this case, I said to the broker, who are the other lenders that you took this to? And would you mind sending me copies of their terms, or at least just giving me a breakdown of what the terms look like? And again, this really highlights that stress testing point again. There are lenders out there in the market going after foreign national buy-to-let business, but on low yielding property, if you stress test, often they won't be able to deliver a sizable loan. So in lender one's case, at 4.39%, with 140% rental cover, they can lend 57% loan to value. Lender two needed 125% cover at 5.29%, and they were at 54% loan to value. And as you can see here, with no stress testing and a pay rate of 4.49%, we were free to lend up to 79% loan to value. Now, clearly we wouldn't lend at that level, but again, the point is that we're not restricted. Just one point that I forgot to mention, and this is slightly off track, which is completion timeframes. I remember completing this deal. We often find that with new build property, the timeframes for completion are very tight. Often the developer has served notice on the tenant and they have to complete by a certain date. Octane Capital are primarily a bridging lender. So all of our systems and processes are geared towards bridging completion timeframes. And there is no difference to our process for buy-to-let loans. So we are completing buy-to-let loans in the same time as we complete bridging loans. The average time frame from application to completion is 2 to 5 weeks, but they can go much quicker than that. So don't think that we are, operating at the same speed as other buy-to-let lenders, because that's not the case. And finally, this is my final case study. This is a really complicated case, just to show you just how far down that complex end of the market we can go. Here we had a first-time buyer, first-time landlord. So this chap was living with his family in rented accommodation, didn't own any assets in the UK whatsoever. He wanted to buy a 9-bed HMO as his first investment property. To make matters more complicated, the HMO had no planning permission. So it only had planning to be a single dwelling. And to compound matters, one of the 9 bedrooms was occupied by a protected tenant, which meant that our valuer couldn't get inside that room and value it. So obviously a really complicated case here. So how do we get comfortable? Well, firstly, we're okay with first-time buyers buying HMOs, as long as they have a managing agent lined up to manage it on their behalf. The planning permission, no planning indemnity is always useful, but also in this case, we could demonstrate that the property had been let as an HMO for many years. So we got comfortable with continuous use. And in terms of the room that the valuer couldn't get inside, well, we just had to take a view on that. There's nothing we could do. So we just had to, put that to one side. And as you'll see here, we've moved up another notch up the rate scale. First time buyer, first time landlord, no planning, big HMO, there's lots of complexity in this case. So we're 0.5 up the scale, 5.99, 4.99. Everything else is the same. 5-year term, no ERCs in the final 2 years, no stress testing, only 100% rental cover at the 4.99% pay rate. Obviously, that's less of an issue for an HMO, but yeah, the structure is still the same. As I mentioned at the start, we're not just a buy-to-let lender, although this buy-to-let product that we launched start of last year has rapidly become our most popular product. We are a specialist short-term lender, and we cover almost the full spectrum of the specialist market. So that includes bridging. We lend on residential property, commercial property, and land with planning. Developer exits, so if somebody's built a development or just one property using development finance, if they need more time to sell that property, finish or sell it, we can step in and clear the development debt and give them the time that they need. And residential refurbishments, people buying property and converting it from a house to an HMO or a house to a flat, we can help with those sorts of projects. And the great thing about that for us is that if somebody buys a house, converts it into an HMO, and then needs a buy-to-let exit, we can help with each stage of that process. And you, as the introducer, would get paid on each loan as they completed. So that's me. I know Tony's just jumped back on, so maybe that's my signal to stop talking. But I hope you found that useful. And if anyone has any questions, please let me know.
No questions yet. Just as the slide says, everybody, if you have any documentation needs, our website is now set up. So it's like a massive stationery cover is the best way to describe it. That we're trying to get every lender that we deal with on their current criteria, their current documentation. Also because it's easier then for my staff to then find out exactly what's needed. So everything is there. It's got telephone numbers there. I would say probably Octane has been one of the most valuable products that we've had, of the buy-to-let product that we've had in quite some time. So it really does lead on to it's led on so much other business for us. So the client that Josh highlighted that we did the 1.3 million for last year, that's led to, he was absolutely delighted because he'd been turned down elsewhere. That's led on to his parents coming to us and now we're arranging a loan of 12 million for them across their entire portfolio. And another one we completed last year. The client again was so impressed with what we was able to do. He'd had a bit of a sketchy past on his mortgage payments, but everything was fine in the last 12 months. That was a much smaller deal on one property. He's now come back to refinance his entire portfolio. He's been stuck in Ghana, unfortunately, for the last 9 months, so I couldn't get over here because of COVID. But he's now, we're now almost in a position where we're going to present that to Octane as well, because he's currently paying on average 5.8% on standard variable rates. But with his checkered past, it'll make it difficult to go, well, impossible to go mainstream. So we haven't got any questions from the delegates, Josh. So these are the ones that you asked previously. So I'm just going to read these out. I've actually changed one because you actually answered it within the presentation. But do you have a minimum income for foreign nationals?
No, we don't. So it's a good point, actually. We don't have a minimum income for anything above our cheapest rate. So our cheapest rate has a minimum, the 4.99, 3.99% rate. The minimum income requirement is £30,000 per year for the borrower, but that can include property income, all types of income. Otherwise, no minimum income requirement at all. So we do lend to people with very low income, or even in some cases, no income at all.
Okay, second question. Do you stress test the background portfolio?
We don't. So that's another key difference between us and other lenders. We don't stress the background portfolio at all.
Okay, the other two questions you'd already answered, so I'm not going to bother. Well, actually, I could say, can you lend to those with adverse credit? I think you possibly already covered that.
Yeah, we can. In fact, our appetite is very broad, so it can get really quite adverse. So we can look at people with, historic bankruptcies, IVAs, missed mortgage payments, CCJs. Yeah, we have appetite for that.
It's all within the criteria that we sent to all of you. So just check that if you need any finer detail. One thing I am going to say, I mean, you mentioned about service proposition. We have found certainly, well, I mean, we all know how difficult last year was. I even put a link, I very rarely do this, but I even put a LinkedIn post up because the service that we had from Octane between offer and completion was quite simply the best I'd seen in years. I've never come across a buy-to-let lender as proactive as they are in just ensuring. I mean, they got senior people ensuring that solicitors are doing their jobs. If something crops up that they think, well, that's not really, we're not really concerned about that, they'll cover it off straight away rather than solicitors dragging it out. Because we all know solicitors like to have the clock's ticking and they earn a bit more money. They really have been on our cases superb in that respect. So all I'd also say is if you've had any cases that have been declined, buy-to-let cases declined on the ICR, on the income calculation ratios, pull them out, have a look at them, send them over. We'll run them through our software system and can let you know pretty much straight away what can be done. Because I can guarantee there'll be some cases that you would now be able to write that you've not been able to write before. Guarantee it. So no questions from the delegates at all, Josh. So it means you've either covered everything or they're all off making themselves a sandwich. So I'm not quite sure what it is. But great stuff as always. Appreciate your support for everything we do. We do love Octane. We've had two cases that have been valuations actually carried out for Octane this week, which is a total of 5.3 million quid worth of business. So as you imagine, we've got two very excited introducers that are just waiting for the vows to come back, but we're sure they're going to be fine.
And an excited BDM.
Yeah, they're very excited BDM, so I'm sure there might be a little bit coming his way as well. So, but seriously, if you have anything that you could think of that you've declined or you've had to decline because of it just didn't fit on the income side of things, then dig it out, give us a call. That's what we're here for. Dilip has asked a question. Dilip isn't the only delegate we've got today, by the way, but he's asked a question. Hi, Dilip, thank you again. What income proof do you require for foreign nationals?
Just for foreign nationals, really, it's just about painting a picture of how they attain their wealth. So if they are, it depends on how they're employed. If they're employed, then just do they have pay slips or dividend payments? Just any evidence that you can give us that they are earning their wealth through legitimate sources will be fine. There's no one set answer to that question.
Okay. And Reza has asked, are clients limited to your panel of solicitors?
No, well, we actually don't allow dual representation. So we would instruct our own solicitor, and they would need to instruct their own. They can choose whoever they like, as long as they've got a minimum of 2 SRA managers.
Okay. Right, there's no more questions coming through. Josh, thank you very much indeed.
Thanks,
as always, we'll no doubt speak to you this afternoon when the first of those valuations come in. Our next speaker is John Thompson, who we've not met yet because he became our BDM during lockdown. But he's been in the industry for some years. I've got a feeling I might have met him before when possibly he wasn't bearded, maybe had a little bit more hair, not sure. But we look forward to meeting him. He's still not come on. No, he's still not there. So I'll talk very, very slowly. Okay, you should receive this from us or from me this morning. So you should have the summary of secured loan products. Step one, quite an unusual lender in the second charge market, in that they will do stuff that pretty much nobody else will do, including Luxon together sometimes. Don't have income multiples. Very, very good lender to have on board. I've got a great relationship with the ops director, who I've known for many, many years, and they're a really valuable part of our panel. Okay, a little bit on John first of all, and I'm really hoping that he is going to come on board, because if he doesn't, we might have to switch to the fourth presenter if we can't find him. So John is fully CMAP qualified and has over 20 years of experience in the second charge residential and second charge buy-to-let industry. Away from work, he is a keen sportsman who likes to play football, tennis, and regularly visits the gym. He also enjoys countryside walks with his wife and children. I prefer my countryside walks with the dog to get away from the wife sometimes, and she will probably say the same. And all my kids have actually fled the nest now. So, obviously a very active man, but just a little bit elusive at the moment. Where is he? And John is the team manager of his son's under-15 football team, something I've done myself in the past. I was the manager of my youngest son, who you saw the picture of earlier on, his team from the age of 11, which was great because they used to do as they were told. And then gradually year on year, you saw a little bit of bad behaviour coming in. By the time they got to 17, I gave it up because I was sick to death having to wake them up in the morning because they'd all been out on the drink the night before. Or the one time when they all went to a party the night before and none of them slept, and we played the team. We were top of the league. They were the team we played were bottom of the league, and they beat us 5-0. Not beat us, beat my team 5-0 because all of my players were basically out of it. So I then decided to give it up because I'd literally just had enough of looking after other people's teenagers. John's now there. Good, fantastic. He's about to come appear as a presenter. There he is. John, welcome. Can you hear us?
Hello.
Yeah, can you hear us?
Yeah, I can do. Yeah, hi Tony.
Can you see us? Yeah.
Yeah, can see
you.
Yeah.
I've already done your presentation. I've not slagged you off too much. I don't know how much you heard. Just talking about running football teams because I used to do it as well. Yeah, they're great when they're 15. Wait to get to 17. You want to kill them. So,
yeah. Well, we had our local derby last night and came out victorious. So happy about that.
Sounds good. Right, we'll crack on because next slide is yours. So I will see you in 20 minutes, John.
All right, thank you, Tony. Okay, hello everybody. I'm John Thompson. I'm the BDM for Step 1 Finance. What I'm going to do today is go through all about Step 1 Finance and how we can help you and your customers with regards to secured loans and second charge buy-to-let loans as well. Okay. Just having a couple of issues with the presentation coming up at the moment.
John, it looks like you've actually deleted your presentation. So what I'm going to need to do is to get my IT team to put it back.
No problem. I mean, I've got a copy of the presentation here, so
no problem. I can just add it back on. There you go. It's back on. So no need for IT. If are you having problems actually going between the slides, or
I I'll see if I can go between the
I
slides.
can do it. I can do it if you like, because I can do it from here. You've not got many
Okay,
slides.
yeah,
on
you
there,
do it
so-
from there, Tony. That'd be great.
Yeah, I'll be your glamorous assistant for the next 15 minutes. I won't say anything.
That's lovely. Okay, thank you. Yeah, you can whiz on from that one. Okay, so yeah, what I'm going to do today is go through an introduction about Step 1 Finance. I'm going to go through our criteria highlights, some unique selling points that will help you in obviously sell the cases to your customers. I'm going to go through our simple income and affordability assessment, how we work out affordability, which is really easy. I'm going to cover our adverse credit and how we work that out, and ultimately COVID-19 criteria. You're probably all sick to death of COVID-19 and criteria around it, but it's important I do cover that as well. There's a couple of case studies as well that I will cover for you, and then there'll be time for some questions at the end. All right, thanks, Tony. If you can whiz that one on. Okay, so all about Step 1 Finance. We're established in 2010. Our mission is to operate as an industry-leading consumer finance platform. We have got traditional lending values. We seek to offer products that are easy to understand and provide real solutions for our customers. Main goals then, we want to be creative and effective in the lending solutions for our customers. We focus on offering customers a personal service. So when your customers and yourselves submit cases to us, you will be allocated a dedicated underwriter that will look after yourself and our customers right through to completion. We look to lend responsibly and be transparent with our lending as well. Okay, our management team have got loads of experience. So my boss is called Hayden Jones. He's been working for Step 1 Finance for the last 4 or 5 years. And then head of lending, Martin Porter, that I think Tony knows. He's been in the industry for well over 20 years now. So loads of experience in our management team. Okay, we've got products covering second charge residential and second charge buy-to-let. We previously had bridging and unsecured finance as well. Those two areas of lending are now paused. So we're dedicated to second charge residential and second charge buy-to-let products. We've got solid funding from large institutional partners. So what that means is we didn't have a break, throughout the COVID-19 pandemic. We lent right through, whereas other lenders were pausing or stopping lending. We're looking to drive business forward in the future as well. So obviously welcome all cases from brokers. Okay, we've got a good reputation in the industry for being pragmatic, having common sense lending approach, and making common sense decisions. So on the back of that, you can look to refer cases over if they are slightly out of criteria. Put a good case together. You can send it over to myself or Hayden, and then we'll fight your corner with regards to if it's the right thing for the customer. Then we will look to potentially write that business. Okay, and as I've mentioned, you've got access to a decent panel of underwriters. We've got probably, I think there's 10 or 12 underwriters at our head office in Woking. Okay, thank you. Okay, so some criteria highlights. We do loans then from 5,000 up to 500,000. On residential, anything over 150,000, you'd have to run through a referral, and anything over 100,000 on a buy-to-let second charge, we would look to do, but you'd have to refer that over. So anything up to 150,000 on resi and 100,000 on second charge buy-to-let, then that's what we'd look to write. Anything over that, then you could look to refer that over. Okay. Terms then, you can do terms between 6 years and up to 30 years. Minimum age is 21 and there is no maximum age. So what we look to do is if the loan is looking to be plausible and sustainable for the customer, then there is no maximum age. So that's a real good benefit of going with us. all we'd look to do is just make sure, like I say, it's sustainable and affordable for the customer. So on that basis, we do a lot of loans for elderly customers who can afford the loan going forward. Okay, rates wise, anything from 6.9 upwards. We do offer fixed and variable rates, and there's no difference in there's no premium for taking a customer on a fixed rate if it's the right thing for the customer. ERCs are the same on all products, whether they're fixed or variable. So it's 4%, 2%, and 1% in year 1 to 3 on all products. We will do loans for any legal purpose, and you can charge a broker fee on the loan of up to 15% with a maximum fee of £5,000. So what the industry average at the moment is around about 10%. So obviously bear that in mind when you're quoting customers to win that business. Loans are available then anywhere in England, mainland Scotland and Wales. So England, Scotland and Wales, and we'll accept AVMs, so electronic valuations on loans up to 80%. You're going to need to get a full valuation if you're doing a loan on a buy-to-let property or in Scotland. Okay, so electronic valuations up to 80%, which is obviously quick and easy for the customer. It saves you a bit of money as well when booking valuations. We'll do equitable charges as well, up to 80% LTV. So an equitable charge, just to recap over that, if you don't know, is when the first charge lender won't provide consent. The maximum loan we'll do on that is 50,000, and we do need a letter from the first charge mortgage company just to say the consent has been declined. Okay, so it's a good benefit of going ahead with that one. Okay, thanks, Tony. Okay, so some USPs to help with your sales with your customers. We'll do residential loans up to 85% LTV and up to 150,000 with customers with adverse credit. Buy-to-let second charges up to 75%, so 75% for buy-to-let second charges, and we'll do those up to 100,000. Again, customers can have adverse credit. Okay, loan sizes, we'll do up to 500,000 on referrals, and as a recap, it needs to, anything over 150,000 on a resi or 100,000 on a second charge buy-to-let, so you will need to refer it over. Adverse credit plans are available on all products. Benefit of going with Step 1 Finance as well, we don't do a credit score, so it also is all down to what appears on the credit search. And then we'll look to write that business depending on how many adverse units the customer has. So it's a traditional way of lending, and it's been appropriate and really good for the customer. Okay, so we'll do an equitable charge up to 80% on resi and 75% on those second charge buy-to-lets for loans up to 50,000. Another good point that USP that we have is we'll lend behind equity release first mortgages. There's no maximum age as I've mentioned, so we'll do customers who go into retirement as long as it is plausible and affordable for that customer. And again, we will consider a buy-to-let purchase, things like tax bills, transfer of equity. So if we need to repay off an ex-partner, then that is something we'd look to do as well. Okay, property types, we'll consider most types of properties. We won't do HMOs, so where there's multiple occupants in the property, but we do consider most types of property. If there's anything you're unsure about, again, it's worth referring cases over, and I can take a view. Obviously, talk to my team at head office as well. If it's something a little bit unusual, then don't hesitate to get in touch, and we can look to see if we can help for you. Okay, and as a recap, AVM's up to 80% LTV, property value up to 750,000. So you can do an AVM on a property value up to 750,000 and a maximum loan size of 75,000. Anything above those figures, you'd have to get a full valuation. Okay, and that's on residential only. any buy-to-let properties, you're going to have to get a full valuation on those. Thank you. Okay, so income and affordability is simple and easy to use. It's an Excel spreadsheet, and what we do is it is a simple I&E form. Okay, so we don't have anything hidden in the background. There's no DTI ratio limitations, so no debt to income, no loan to income calculations in there. It is a simple I&E. There's no strict minimum expenditure levels, although our underwriters do look at ONS figures, and we'll consider those when they're looking at what figures you're putting down on the income and expenditure document. Okay, like I say, it's a simple calculator. There's a minimum financial cushion applied in there, and as long as it fits for the customer and is in by £100 at the end of the I&E form, then it's something that we'd look to write. Okay, we'll use overtime and bonuses for most occupations, and we'll also look to do loans for contractors. So with regards to contractors, we'll use a day rate when we're working out the figures to use, and we'll look at over 5 working days and over 46 weeks to get the yearly figure. So contractors are something we do, quite a lot of business for. We do self-employed applicants. Most are considered, and we need 3 months bank statements just to show up-to-date income going in for those self-employed customers. The customer will have to then submit either 2 years worth of SA 302s or 2 years worth of account certificate with a projection for the forthcoming year. Okay, we will consider customers on benefits, but we won't do benefits only cases. So customers can have a proportion of their income through benefits and some employed income, and we'd be happy to look at that. Okay, buy-to-lets are really simple as well. It's a same for affordability assessment as a residential customer. So again, using that simple I&E calculator, as long as it's in after obviously the expenses, after the mortgage payments on the buy-to-let property, as long as it's in by £100, then we'd look to do that loan on the buy-to-let property as well as a second charge. Okay, thank you. Okay, so how do we assess adverse credit? Like I say, really simple. There's no credit score. What we do is we look at the Equifax search or experience search, and we look at what type of adverse units the customer has. Okay, we look at unsecured credit, we look at mortgage credit, and the customers can have up to 4+ adverse units on the credit, and we can still look to do a loan on one of our plans. Some other fantastic benefits are we do customers who are in debt management plans or who are in IVAs. So with regards to an IVA, you have to pay the IVA off with the loan. Okay, the debt management plan, if it's better for the customer to leave the debt management plan running, then you can leave that running. Alternatively, you can pay that off with the proceeds of the loan. So IVAs you've got to pay off. Debt management plans you can leave running if it's the right interest for the customer. Okay, and again, we are able to work outside criteria if necessary, and it's really worthwhile referring cases over if you think, hang about this, it looks like a positive solution for the customer, but it's slightly out of criteria, then get in touch, and then we'll look to see if we can look to do that business for you. Okay. Okay, so COVID-19 criteria. Applicants currently on furlough are not acceptable. Hopefully this is something that will cease very soon when everybody goes back to work in June. Then potentially, hopefully we'll hear the end of furlough. But for now, anybody who's on furlough, it's not going to be acceptable. Applicants who have returned from furlough need to provide evidence that they're back to normal. So we're going to need things like a letter from their employer. We can't see furlough on the pay slips, so they're going to need to have pay slips to really show that they have gone back to work on a full-time basis. Okay, any payment holidays, again, they're accepted. However, we need proof that they've started making payments again back to the mortgage. So a letter from the mortgage company will suffice with regards to that. So just confirmation any mortgage payment holidays have been concluded there. Again, we'll accept customers where they've got, grants from the government, because lots of self-employed customers have had grants and businesses have had grants, so we will consider those. So that's a general overview of COVID-19, and hopefully we'll be able to see the back of COVID-19 very shortly. Okay, thank you. Okay, so a couple of recent case studies, just to give you ideas of something a little bit quirky that we have written. So we had a case where the loan was for 215,000. So out of our normal 150,000 parameters, it was referred over, and the loan was for consolidation. There was no adverse credit. We've got a couple of applicants. One was employed and one was a contractor. So the contractor, the issue here was the contractor was coming to the end of his contract. Okay, but we can see previous history that he's always had it renewed. And ultimately it was going to be ending in 3 months' time, but we did write that business on the basis that it was likely to be renewed after looking at previous renewals of the contract in the past. We've got another case study where we did a loan for 96,000. We did a loan for consolidation, and then we repaid some income that the parents had lent the applicant. Okay, so we did LTV was 65%, property value 1.1 million, and there was some adverse credit on the unsecured loans that they had. Applicant one was a self-employed engineer, and then applicant two just had pension and benefits. The case had been to Together, and the offer had been withdrawn from Together. And what we did, we agreed to do an AVM, which was still out of our criteria. Ultimately, the customer had paid for the valuation with Together, but the valuer wouldn't do a retype for us. So we agreed to proceed with that on an AVM, which was out of our criteria, but we looked to write that business for the customer. So a couple of case studies there. So that's me coming to the end of a presentation. With regards to documentation, it's available there. So you go to lenders.specialisthub.co.uk/step 1. There's loads of documents stored in there. So we've got decision in principle forms, we've got application forms, and there's loads of information in there. Okay, and again, if you need to discuss a case, there's a couple of telephone numbers, a telephone number or an email address there that you can get in touch with.
John, thank you very much. You mentioned about people giving you a call. I know you run a very limited panel, as do many second charge lenders, purely because they haven't got the capability of dealing with everybody. I'm not sure if Step 1 have actually gone out to any of the networks either, as some others have. So hence the reason, if you do have anything, then quite simply pick up the phone. My team are waiting. My team have been dealing with Step 1 since they first started, all the way back, it was years ago now. John mentioned Martin Porter, who's the ops. What's his head of credit? Did you say?
He's head of lending now. Yeah, head of lending.
I always thought he was a director. You mentioned around 20 years. He's actually been. I first met him in 1987 when I started working for a brokerage, and then went to visit him. He was a lot thinner in those days, but he's a lot thinner, a lot fitter as well. He used to play rugby a lot. So
did he? Right.
So I've known him for. I've actually known him longer, and my oldest child has been on this planet. So that's quite frightening. Okay, we've got a couple of questions. First question, great question actually from Melvin. What is the benefits to earned income ratio? Some lenders have a cutoff, e.g., greater than 50% is benefit income.
So what type of benefits income will we use?
No, that's basically saying, so if you had somebody, for example, who was earning 10 grand a year employed, this is about, I think this is what Melvin's asking. So if you're earning 10 grand a year employed, but then there was 8 grand a year in benefit income, is that acceptable? Because it's run 80% of the employed income is additional income by way of benefit.
Yeah, it is. We'd look at it on a case-by-case basis, but as long as there's some employed income in there, then that would be fine. As a lot of customers' incomes are made up of various things, various items of benefits and employed income. But yeah, that would be fine.
Okay. And Bavan's asked, we are part, I never know how to pronounce this. We are part of the Paradigm Club. Do you accept us? I don't think Paradigm is one of the ones that's on your sort of like network panel, as far as I'm aware. Bavan, probably a good idea. I've written to your managing director very recently to actually get us on your panel of packages, because we've got one very interesting product which you'll hear about in my final presentation, which would suit you down to the ground, I believe. So maybe have a word with your MD and ask him to take a look. I've actually sent him a letter rather than just an email, just so that that's something they can maybe consider. We don't have any more questions to delegates, but we do have some that there was a couple, John, that you've already covered in your presentation. But this is a question I'm asking a lot of lenders at the moment on the second charge side. Because many employers are now they got their staff back full time, but there are on occasions they might furlough a staff member for one day. Is that acceptable?
It is, but we need to see pay slips ultimately without furlough on. If there is the odd day there on there, then we could potentially use just that income, but not the furlough income. So it'd be on a case-by-case basis, but we do understand that people are going in and out of furlough. So it's worth again referring those cases over, and we want to do the business.
I do know that some employers are actually, when an employee wants to take some holiday, they book the holiday and they then furlough them for that day.
Yeah, I can imagine. I see it.
So I mean, we're seeing
sorts of happening.
So again, that's delegates. If you have any cases like that, it's always best to give us a call, because my staff will deal with John. And this is nothing against John, but I would deal with Martin, because that's my contact at Step One. I've known him for donkey's years. We're Facebook friends. We've got drunk together in the past, all that sort of stuff. So I've known him for a long, long time. He's my point of contact. So I would run a deal past him if there's anything that is, slightly quirky or slightly unusual, because there's always a good explanation behind it. But some employers are taking advantage of that at this moment in time. I just also wanted to talk a little bit more about lending behind equity release, because you don't need lender consent on those products, do you? Or do you?
No, again, so we'll lend behind those equity release. Most equity release companies won't grant consent, so you don't need consent on that one.
Okay. So, which is a great product, and that is unique in the marketplace, and it's something that I've been banging the drum for some years now with lenders, that equity release, you immediately got affordability, because I'm not making any payments on the first charge. So the second charge affordability is that much better. But Step One are the only lender so far that have actually caught on to that and have said, hang on, that's a really good idea.
Yeah,
it's something. And that's been out for quite a while now. But no one's come out of anything similar, which amazes me. It really does. Is there anything else? Excuse me. No, I think that's it. I think we've got everything we need. You covered everything. There's no more questions coming up. John, thank you very much indeed.
Yeah, it's been a pleasure. Thank you very much, Tony.
Sorry about all the little issues at the start, but we overcome them in the end. The technology, I can actually work the thing these days.
You've been a great assistant, Tony. Thank you very much.
No problem at all. Not that glamorous after all, but I'll do my best. John, thank you. So this is Jim Nash, who I've known Jim. Blimey.
I was trying to figure that out earlier. What do you think?
I have no idea. I think it's 80s. I'm pretty sure it's the 80s. But as you see, Jim is an actual person. He's not a cartoon character. Jim's one of the people in the industry I would consider to be a good friend rather than just a business acquaintance. We've known each other donkey's years. He's always been within the lender market as far as I can remember. I'm not sure if he's ever gone to the broker market. But he's ended up back up with lenders. The lender he's with now, he's been with that particular, the MD of Tuscan Capital. Jim has worked for him for a long, long time. And he does know his stuff. He really does. There's few in the marketplace that know as much about bridging as Jim does. Let's put it that way. And he has covered the whole multitude. I think the very first time I sort of met Jim properly on a social basis, he was working for iGroup as was you head of collections or head of customer services?
Yeah, customer services, collections.
So he was quite senior at that stage. He's sort of like gone down the ranks a bit since then, but
no.
He's still okay. He's a BDM these days. I never contact him on a Friday afternoon, unfortunately, especially now the pubs have reopened, and that's another matter entirely. So,
Yeah,
everyone, you should have received this on email this morning from me, the Inside the Box Solutions piece with Tuscan and our bridging logo. A little bit on Jim. He's an industry veteran of many years standing and has experienced firsthand all the ups and downs of recent and not so recent financial services history. And the majority of Jim's experience has been gained in broker-facing sales roles, including time spent with National Mortgage Bank, non-conforming lenders such as iGroup and Money Partners, and bridging provider Omni Capital. He's brokered a bit in his time. I don't remember that bit about him broken. He's a dedicated follower of the bridging industry, Spurs, golf and Guinness, but not necessarily in that order. Hence the quote about not being contactable on a Friday afternoon sometimes. A little bit on Jim. This is his interesting fact, and believe me, he's not going to be doing his presentation in song today. You'll be pleased to hear. He was once on TV in a choir and sang with an old group called the Beverly Sisters. I think this was just after the Second World War. This happened.
Something like that.
The program was Stars on Sunday. He was, however, only allowed to join the choir if he promised not to sing, which is really sad. How can you do that to a child? How cruel is that? Jim, it's over to you. We are running ahead, which is great. So if you can keep it at that, you haven't got a lot of slides, which is great. So keep it at that. That'd be fantastic. I'll see you in 20 minutes. Over to you.
Get down to, have you got my slides there? Oh, you've gone, but I'm not sure. Let me just see. Sorry, folks.
I'm looking at your first slide.
Yeah.
If you can't see it, I'll do the same as I did with the last one, which with John, the last presenter, where I was clicking the slide. You've only got 7 of them, so.
That's right. I've got the first one, but the ones below, I've dropped down to number 4. I'm not sure. Hold on. Let me see. Hold on.
Well, you go.
Here we go.
That was you.
Yeah, that was me. Okay, we're fine now.
See you in 20 minutes.
Yeah, we're fine. Okay. Okay. Well, I've had the introduction. Good morning, good afternoon to everybody. Chris, I can now. We're going to go through what we do. 150 other bridging companies. We all appreciate that. But the team that I work for, small team, there's only 10 of us. And between us, we have we have over, as I say, 150 plus years of experience between us. I'll just go straight into our criteria, which you can see in front of you. National coverage at the moment is England and Wales. We're exploring Scotland, something that's coming down the line. Rates, we're competitive. Tony doesn't even know this yet, so I'll talk to Tony afterwards. We've just been having a discussion regards rates, which I'll talk to Tony about for certain packages like Tony. We're looking to offer something which, as I said, I'll talk to Tony about afterwards, and he can convey that on to all of you guys. Term, 3 months to 18 months. There are exceptions to that. We have gone to 24 months on certain occasions. Loan to value, 75%. We work to open market value, not to 180 or 90 days. That's open market values. That is on first charges on residential investment, HMO type properties. Okay. Loan sizes from 150 up to 10 million. Again, we can look to go outside those parameters, a little bit less, a little bit more, depending on the deals. Types of properties we will consider. You can see there, new builds, HMO, semi-commercial, small blocks of flats, buy-to-let portfolios, which I'll get onto in a moment to give you an idea of the size portfolios that we're quite happy to get involved with. We'll deal with, again, foreign nationals, expats, all down to know your customer. We'll deal with PEPs in certain situations where there's certain levels of being a PEP. We have a facility whereby we can look, and depending at the level of PEP that we're considered, different KYCs required, anti-money laundering procedures are required, but we can do them. Individuals, SPVs, offshore companies, we will allow all of those to come to us for a facility. Credit approved term sheets, typically inside 24 hours, and I would say on at least 80% of the occasions, a lot less than 24 hours. Okay, let's moving on. Okay, a product at the moment which is very, very trying to think now. It's a favourite with us at the moment. We've got a large number of these deals on the go. Is this refurbishment facility? What we're looking at is situations where you can change low yielding assets into high yielding assets, normally HMOs, because they are obviously high yielding. So we're looking for experienced developers. Now, again, there are exceptions to this if the development company are experienced and if our client strong A&L and they prove that they've done stuff before, but through certain developers, we might look at somebody who might have done his first or second project. First charges only, England and Wales. Now, what we look at is 70% of the initial cost of the unit, and we will look at 100% of the build cost, the refurbishment costs, looking at a 65% to the GDV is the ultimate value that we'll go to. What we're not good at this moment in time is we won't do ground up developments. So we're talking about purchasing of different types of assets classes, which I'll get onto now in a minute. And as long as they've got planning or PD in place to convert to HMO buy to let, that's where we will get involved. We have a project manager who will keep an eye on it for us. And as I said, we'll do 100% of the build costs, and the overrun costs, though, the client's got to cover that themselves. So, moving on. Okay, so just to give you an idea now of the type of deals that we've been dealing with recently. If I go through them, and the idea here is that we will cover from up north, down south, and across all the way, as I say, into Wales. So this gives you an idea of where we'll cover. So you've got your first example there in Bury. Okay, what this was that the property had reached PC, and then we refinanced the existing facility. And what that did was it gave them time to prove income to then put that onto a long-term facility. Barnet, this was what we call a marketing bridge. It was simply to repay an existing facility, which was going to be quite expensive. And we went to 75% loan to value, which I feel in the marketplace, especially when you're taking out an existing bridge facility, is normally you might be around your 60, 65, maybe 70, but we were quite happy to go to 75. There was good comparables that we could look at. And as I say, and that was in Barnet, and then we can go across to, I could go through them all individually, but I won't do that. You can see for yourself, Leeds, an acquisition. It was unusual. It was a conservative club, but what it was that it didn't have the permission in place at the time to do what it wanted to do, which was to go to Resi, but they offered up some other unencumbered properties, so we cross-collateralized, and as you can see, we went in, let them complete the purchase. It worked out just under 70% across that very small, we'll call it a portfolio of 4 properties. And then again, you can see up to Liverpool. This was where we did 70% of the purchase price. This is this refurbishment type deal, which is very popular with us at the moment. It was in the city centre. We did 70% of the purchase, 100% of the conversion costs. What it was under permitted development, and they came out with a 1-bed and a 3-bed flat. From start to finish, that loan we completed within 18 days, which is pretty reasonable, I would say, especially in these times. Buckingham, another case there. This was where it was targeting the student population around there. There was planning in place for a 5-bed HMO. what they did was we helped them to get in there. They subsequently had the planning change to a 7-bed HMO, and again we have a 70% of the purchase price. So these are the type of deals that we are looking at the moment, and are proving very popular, because to go in, change, reconfigure within the existing envelope, change it into a high yielding asset like a HMO, and then being able to flick it out quite comfortably onto a term product, where obviously the yield and any stress testing that's applied to it, comfortably they work within those parameters. So moving on now, we quite like portfolio deals. If I can just get into my last slide here. These are some that we've completed, again, fairly recently. The first one there is a good example. This is proof of we've increased our loan size up to 10 million now. There are a number of properties here. This was a purchase. It was actually off of a brewery. They were unloading a number of their properties, as you can see, 130 of them. And we got that completed. That was a very good quick completion, considering it was 130 properties from start to finish. We had everybody working flat out, the valuers, the lawyers, 21 working days from start to finish on 130 property portfolio. We were very pleased with that. Loan to value is 60%. All over, it was just a really good deal. There was various, it was a lot of semi-commercial was in there, resi, as I say, as a mixture. We're at LTV across the whole lot. Again, the one next to that, again, there was a number of properties. There was 19 of them. Again, it was just a refinance of an existing debt that they had, and that will be taken out and put onto a term product in due course. Croydon, it says properties. Those are actually apartments, okay, that we lent on there. But again, all I'm trying to say is that if you look at the geography, if we're up to Bury, down to London, we're quite happy looking at any asset class if it's got permission to change into resi in just about any part of the country. Short and sweet presentation, because pretty much we all have a good idea as to what bridging finance is. Tony's team obviously understand it really well with us guys, and as I say, and Tony doesn't actually know this yet, and I'll talk to you afterwards, Tony, because honestly this is a hot offer from the CEO. I talked about rates now that we're going to look to offer to you guys, and that's it. And obviously use Tony because he does 99% of the work for us. So there you have it. Okay, short enough for you, Tony?
That was brilliant, Jim. Yeah, very, very short. I'm surprised you can only talk for 10 minutes about the company you work for, but anyway.
I don't want to bore you.
No, not at all, not at all. I mean, as we all know, there is an absolute glut of bridging lenders out there at the moment. I must be approached by 3 or 4 a week at the moment, via LinkedIn, via emails. And I always say to them, what's unique about you? And if they come back and say we're quick, then I won't, that's an immediate, I just delete the conversation and I won't carry it on, because that's what bridging lenders are supposed to be. The reasons that we like Tuscan: A, the management structure. We've known the management for donkey's years. Colin, the CEO of Tuscan, has been a mate of mine since the 90s. He had an invite to my wedding. He didn't turn up, but that's another story. He was on holiday. That again, it's a relationship we got. So I will speak to Jim. I will speak to Colin. I'll speak with Matt Rogers, who's one of the senior guys there. We got packager status with them, so you could go direct to Tuscan if you wanted to, but you would earn the same by coming through us. And believe me, I've got the contacts within Tuscan to get deals, discuss deals at a different type of level than you will be able to. Quite simply that. They're a great company to have on board. I'm really excited about this phone call we're going to have this afternoon, Jim.
We will indeed, Tony.
Offering interest rates from 0.35% with 4% commission. That'd be great. Thank you.
Okay.
Right, so questions. Let's see. We haven't got anything come up on the lender list as yet, but I've got a couple. Here's 2 that you prepared earlier, Jim. So, which asset classes will you lend on?
Well, as an example, on one of these, if I went back on the slide, we've just lent on a Buddhist centre, but the Buddhist centre has permission to flip it into a resi. So as an example, we're just working on a deal on an old police station, again, which has got permission to change it into 7 units, I think it is, within the envelope. What we, again, let's not avoid it. What we're not good at is pure commercial assets at the moment, unless they actually do have permission, residential planning permission in place. Okay, so besides that, your semi-commercials, as I say, I'll give you an example there of, we've got the Buddhist centre, you've got a police station, we've got a library that we're lending on at the moment, which have got permissions to convert, but not pure commercial. Okay, so besides pure commercial, talk to me about anything else.
Okay, and will you lend to offshore companies and foreign nationals?
Yeah, absolutely no problem at all. It's like everything is that, as I was saying it earlier on, we lend to all types, all classes. Certain, as I mentioned, what some people might consider PEPs, we may not actually consider them full PEPs. We do certain more enhanced due diligence on them, anti-money laundering, etc., etc. But we will lend to them if they're what are classed as a lower exposure type PEP. So we're happy with all of those guys. We look for a footprint in the country of some sort, okay, which we look into. But as you know, we have facilities, smart search, etc. And as long as the KYC and the AML is fine, we will lend to all types. The only ones that we don't like lending to is we don't like lending to charities, and we'll look at trusts, but they can be, again, we don't get many of them, but I'm just letting you know, if you did come across them, they are very complicated, and we try and steer clear of trusts and charities. Okay,
Don't blame you.
Yeah, I know.
I haven't got any more questions. You've obviously covered everything in your 10 minutes that all the delegates wanted to hear, because they haven't asked any questions either. But if you haven't heard of Tuscan, once again, another great lender that we've got on board that can cover stuff that you might not be getting through at the moment. So they will do some of the very unusual stuff, because it's common sense lending from people who've been in the industry for decades.
And we'll be even greater,
Tony,
will be even greater after I've had the discussion with you later on this afternoon.
Fabulous. 4% commission on its way, everybody.
Yeah, very funny. Okay.